Hey guys, welcome to today's video. We're going to be taking a look at the Q1 results for both most of the capital markets and my own portfolio returns. This is a little bit of a return to a series that we were doing when I first started the channel at the beginning of last year when I was doing weekly market updates. However, at one point when I decided to start doing the live streams, I decided I didn't really want to do two of those things at once. And I also thought that the weekly market updates was kind of a little bit too much of a regular update for some of those data items. So I'm trying to kind of kickstart that back into a quarterly update in which we will be going over both the capital markets and my own portfolio returns. And for today's video, we'll also be kind of covering a little bit of my Q4 returns, just so that it's not some sort of thought that I just chose this quarter because perhaps I did relatively well in this quarter relative to the last quarter. We'll show a little bit of the good and bad, and we'll hope to be doing this semi-regularly with the idea that 3 months isn't actually too long. But before we get into all that, if you could please like the video, subscribe to the channel, and perhaps tune in to one of our live valuations that we do twice a week. So to begin this discussion, we definitely want to talk about the movements in the treasury markets, with the treasury markets coming down in expectation that the yields were going to be moving up, which they definitely did start to move up with the Federal Reserve's movement of the federal funds rate upward by 25 basis points. So the most of the treasury markets were moving into a bear market, prepping for the eventual lower prices that the higher yields would give, which you can see on the right hand chart, the actual movements of the yields relative to the actual returns on the left hand side. The tips return, which is the green line, is a little bit of an estimation based off of the previous month's CPI rate numbers, so that's why it's kind of an arbitrarily straight line, which is a little bit of a misleading effect. It's not actually that non-volatile, but because of the way that the calculation in the spreadsheet works, it kind of looks that way. And in line with the movements of the treasury yields, we also get the corporate spreads moving upward as well, and with that their own returns moving downward pretty significantly. And as far as the corporate returns go, you can see that for a little bit there the emerging market corporate spread was actually doing relatively well, and then by the end of the quarter it actually ended up doing the worse, with the US corporate prevailing in the end. Switching over to sovereign bond returns, in future quarter updates, I actually hope to have a little bit of a spread of specific country sovereign bonds, but I have these index returns which estimate some of the returns, which is why I can't get the yield specific information. So instead, the second chart, I just have currency returns. The currencies I selected being a little bit of a select group of currencies that are relevant to me, not particularly representative of a whole batch of currencies. The DXY, which is the blue line on the right hand side there, being the dollar index, you can see it's up relatively compared to where it was a quarter before. However, because of the fact that I'm not including some of the currencies that are counteracting here, you can't necessarily see some of the weights that are causing it to move the way it did. Like I said, this is just a select group of currencies that's relevant to me. But as far as the actual sovereign bond returns themselves, you can see that emerging market government bond returns have done the best over the quarter, which has to do partially with the movement in the yields in treasuries and how that moves across domestic and developed markets. So this is a chart I definitely like to look at, which kind of combines a lot of the information from the previous slides. This is the debt premium stack, which basically takes different layers of differences between different yields, coming up with different spreads for different purposes. The bottom of it being the real risk-free rate, which is the 10-year tips yield, which is in negative territory, which is why it's below the 0% line, as you can see. On top of that, I have the expected inflation, which we get by subtracting out the 10-year tips from the 10-year yield, getting an idea of what the expected inflation over a 10-year period is. And so you can see that that's up, moving upward ever so slightly, not super up over the period, but it was around 2%. Now it's closer to 2.5%. And then above that, you can see the time premium in yellow, which is the difference between the 2-year and the 10-year, giving an idea of the premium that bond investors demand for waiting for the return upward to 10 years. And that spread literally disappeared almost entirely by the end of the quarter. It actually fully disappeared only just yesterday. And then above that, we get a low risk premium, which is like a high grade investment grade corporate bond, and then above that we have the high risk, which is the high yield corporate bond, but in developed markets in US dollar. And then above that we have the EM premium, which is basically switching from the US dollar over to emerging markets. So you can get an idea of like how risk is built on top of itself based off of these different premiums, and this applies to the bond market. We are primarily equity investors on this channel, but I like taking a lot of time to look at the debt markets to get an idea of how the markets are pricing these different types of risks, because then equity risk is only then stacked essentially on top of this. So with that, there's also talking about the commodity returns over the quarter. In terms of the title, basically talking about a new transition, I'm referring to the conflict we have in Russia and Ukraine, because that kind of is the new going story as for why the commodity prices are skyrocketing. The previous story being that we were in transition from the post-COVID supply chain crunch. And so that being the new explanation, whether or not that's going to be the truth or whether or not that has to do with the long-standing theory that I've generally run on this channel, which means it has more to do with monetary policy. That's generally where my biases tends to lie. But either way, this is a spread of commodities that I like to track for one reason or another. Some of them I have exposure to in various ways. The GSG, which is that blue line, is a commodity index that I like to pay attention to. Admittedly, it's about 1/3 energy overall, and so you can see the movements across the way. Before the conflict began, natural gas spiked, and then after the conflict began, it actually came back down. Now we're seeing wheat and oil coming up rather significantly since the conflict has revved up, ending the quarter relatively high, with some of these more straight lines coming from some of the commodities that I don't get regular information on, chicken and lumber and beef. However, I do have exposure to them, so I like to put them on this chart regardless, even though again it's an arbitrarily straight line. Bitcoin had a pretty rough quarter, though ending itself relatively flat, actually slightly up on the quarter after coming down and back up. It's worth noting that I actually ended my exposure to Bitcoin over the quarter, not because it did poorly during this quarter necessarily, but the way that I like to think about the types of fundamentals for Bitcoin, I decided were deteriorating relative to other opportunity costs. So again, these are the main benchmarks that we like to pay attention to when judging the performance of our own portfolio, primarily the S&P 500, but we do like to think about the spread of all of these main benchmarks, the Russell 2000 being representative of small caps, and the two S&P 500 and Russell 2000 essentially being representative of basically the entire US stock market, not exactly, and then the developed market and emerging market indexes, as well as a foreign small cap index, to get a general spread of pretty much all equities across the globe through these 5 indexes with as little overlap as possible. And as you can see, the emerging markets were doing relatively well prior to the conflict, and then as the conflict began, they started to drop back down, with the S&P doing not so hot for the early part of it, though not the worst. The small caps were actually doing the worst, and then the gap started to narrow as we entered into March, with the S&P then shooting up into first place, at least by the end of the quarter. These index returns do have dividends put in, estimated for a couple of them where I have to. In line with paying attention to the equities, I also like to pay attention to equity derivatives in the VIX index, which measures the options volatility, as well as the put to call ratio, which is just a direct multiple relative to the options themselves. The put to call ratio, I like to look at the total put to call ratio relative to, there's also the S&P 500 put to call ratio more specifically, but the total put to call ratio for equities tends to be a little bit more stable, and you can see that it generally is the case over the quarter, with it ending relatively low, which is not necessarily a super bullish sign if you're thinking about the idea of insurance already being priced in. However, you can also see that the VIX did have some upward movements throughout the quarter, peaking around 35, 37 or something like that, and coming back down. I don't have all the VIX data updated on this chart, but it did end up, I believe, just below 20 or around 20 by the end of the quarter. So narrowing into the US sector returns, these are done through the Vanguard sector indices. That's the way I like to measure it, and I do like to include dividends estimated where it has to be. This is the returns across all the sectors. Obviously, the huge outlier being the massive outperformance of energy, with only a couple of industries managing to essentially hold their narrow line, that being financials and materials for the most part, with the biggest losers appearing to be communication and technology and discretionary. So definitely companies and industries that are more sensitive to economic movements, as well as sensitive to the interest rate crunch and the multiple pullback, as well as then outperformance by industries that are more sensitive to the supply chain crunch itself and commodity exposures. So about what you would expect in this this grouping right here. I did actually narrow my exposure to energy stocks over the quarter, so I would like to think that I was reacting as well as I could in terms of that, and then we're buying as whatever we think is cheap in terms of the other quarters, because there's lots of opportunities. This is a chart of my portfolio daily returns relative to the S&P 500 daily returns. I'm not the type of person that thinks of volatility as risk per se, but I do like to think about volatility and correlation of my own portfolio in terms of that, because I do subscribe to the notion that you can't really outperform an index that you're highly correlated to, because you'll effectively just be in line with the index, adjusted for a volatility measured form of risk, which is to say that if you take on more volatility, you will have a more volatile portfolio. But if you're still highly correlated with the index, you'll effectively just be doing the index in a very volatile way. So I would like to outperform the index, but I think it can be done while being uncorrelated with the index. So I do like to look at least on a chart, and pay attention to these things, the volatility of my own portfolio and measuring beta in terms of that. Taking a look at this chart, this is a chart taking into account all of the cash flow related items associated with my portfolio over the quarter, total disaggregation of my activities. You can see the dividends that I collected over the quarter, as well as the options premium, as well as the total amount of assets that I sold, therefore getting cash, and bought. And so on net, you can see that in dollar terms, or not in dollar terms, in percentage terms of my portfolio, I sold a higher percentage of my portfolio than I bought, which effectively means I was building up my cash position. And then I also did collect dividends and options. And then the subtraction of market value is kind of an illusion. It's not really that I had a subtraction in market value in terms of that way. This is just a way to disaggregate it and to reconcile it back down to my actual return, which is positive, which is in the green bar there at the end. But this is just something I like to pay attention to, which kind of shows the way that your portfolio turnover is being generated over the course of a year. So taking into account the actual returns that I had this quarter and the last, we will look at the fourth quarter first. My fourth quarter return was just over 8%, bringing my cumulative compounded rate of return over my entire investment experience to 20.93%. And then I ended the quarter with an expected portfolio CAGR of 11.98% over my entire portfolio. That includes my cash. That's my cash is considered part of my position, just so it's understood before we get into discussing my cash position in the next slide. So 11.98% includes the cash position, but that's also an expected return that implies I'm not going to do anything. It's essentially saying if I walked away from my portfolio and came back 5 years from now, I would expect to have that rate of return on my portfolio. I actually tend to expect I'm going to do much better than that, because I'm going to be actively buying and selling things when they're under or overvalued. Hence why I have, for example, the 20.93% currently. The S&P 500 return in fourth quarter was 11.03%, and that gave them a benchmark compounded rate of return of 28.86%, which means that if I take a index of when I put money into my portfolio, and if instead of putting money in my portfolio, because again, I consider cash a position, so therefore when I deposit it is when it becomes part of a position, I would alternatively then buy into the S&P 500 and purchase it then. And so I've kept track on a separate spreadsheet what my rate of return would be if I had invested in the index instead with the same deposits. And at the end of the fourth quarter, it was at 28.86%. So as you can see, I have underperformed the index to a pretty significant degree up to the fourth quarter. However, I think the fourth quarter, they ended with the index at a relatively over enthusiastic point, and I think the way it came down since then and my own outperformance of the index since then says that, but we'll get into that. I digress. The expected rate of return for the 5 years that I had for the index at the end of the fourth quarter was 6.49%. So I do expect my portfolio to massively outperform it at the fourth quarter end. And the return ratio, which is the ratio of my cumulative compounded rate of return, the 20.93% divided by the 28.86%, is 0.73. So I've earned 73% of the returns that the S&P 500 has, which is definitely underperformance. I've talked about it on the channel before, so here it is, me saying and showing it directly, underperformance over my entire investing career, however. So that does include the first year and a half to 2 years where, in my opinion, I didn't really know what I was doing. So frankly, I've been playing catch up, hence the title. In the most recent quarter, we did 2.43%. Which is not a very outstanding quarter, and it brought our cumulative compounded rate of return down to 18.61% because of the other co-movements and deposits and withdrawals in the portfolio. Our expected rate of return is up to 12.1%, and the S&P 500 return was negative 4.6%. So I'm pretty happy with my 2.43% relative to the negative 4.6%. That did bring the benchmark compounded rate of return down to 21.43%. Means I'd massively narrowed the gap on their outperformance, which one of the reasons, like I said, I wasn't super concerned with the fourth quarter end, because it definitely seemed a little bit frothy and ready for correction. The expected rate of return that I have currently, or at least a few days ago on the S&P 500, is 7.16%. And again, that brings the return ratio to 0.87%. So you can see how much of the return ratio I was able to cover the ground of, about 0.14 of it. In one quarter, I was able to make up that. So as you can see, really, I'm only 1 to 2 good quarters away from being outperforming again, which is why I don't really sweat it. So taking a look at a little bit of a chart of my returns over the my entire investing career. This is just kind of laying in basic return statistics, summary statistics of my portfolio against the S&P total return during that time frame. Current quarter, as I said, I have a positive return versus the negative return for the S&P 500. My average return, a simple average, has been slightly higher than the S&P 500 total return, which is kind of funny to see because of the weirdness in the movements of it, especially considering my worst quarter actually was worse than the S&P 500, which was in fact the quarter in 2020 when we took the large dive. I actually did have a pretty bad quarter. I just recovered pretty quickly on it, and my max quarter isn't as good as the S&P 500 either, which is pretty interesting to see, and my median being lower as well. So that's why it's pretty funny to see that the average actually comes out higher, but that has to do, I think, with the way I was underperforming for the first half of my career, and I've been outperforming for the second half of my career, and there's just kind of a little bit of a mixed balance between those two currently. So taking a look at some more specific details of the content of my portfolio as it stands at the end of the fourth quarter and the current. At the end of the fourth quarter, I had 22 positions, and in my top 5 positions, the concentration was 40% or so. Just so it's understanding, when I talk about my top 5 positions, I mean top 5 positions by my capital put into the positions, not by market weight. So it comes down to how much money have I put into a position, and not how much has it grown since then. My ending cash position in the fourth quarter was 8.58%, and my average cash position was 9.34%. I do like to look at both the ending and average, because where a cash position ends can be misleading as to giving an idea of what the typical cash activity in my portfolio is like, which has more to do with the current quarter, which we'll talk about in a moment, with the red letters there, than anything. And the cash target, because I do actually have a formula driven method of trying to target a specific amount of cash, at the end of the fourth quarter was 11.19%. And the beta that I have at the end of the fourth quarter, this is the cumulative beta that I have since I started recording my daily portfolio returns against the index, is 0.79, which is just under 2 years of a daily beta in the fourth quarter. So I had 0.74% of the returns, but I had 0.79% of the volatility while holding about 8 to 9% cash. So that's one of the things, again, to keep in mind. Like I said, with my lower amount of returns, it has to do with the opportunity cost that I'm taking into account relative to the large cash positions I'm holding. I'm waiting for dips to buy more higher positions, and on that premise, I assume I'll outperform over the long run. My current portfolio details: we ended this quarter with 25 positions, and top 5 concentration is actually down to about 35%. Our ending cash position is around negative 1.5%. I do have actually a little bit of some margin activity going on, mostly to do with options, collateral, and things of that nature over some specific transactions. But my average cash position over the period was 3 to 4%. Again, that's part of the reason I include that figure, to try to give an idea that just because I have a negative position at the end of the quarter, it does not mean that I hold a negative position for regular periods throughout the quarter. I usually have a negative position for like a 1 to 3 day period at a time. And so it's kind of misleading. However, I have lowered my cash position buying into the downward market, even though my cash target says I should be at like 14 to 15%. But that's part of the reason I've been doing the margin activity, so that I can kind of have cash and not have cash simultaneously. I'm playing both ends of it. And because of the option activity in this quarter, actually, it brought my beta down pretty significantly. It also has to do partially with my outperformance in the quarter. So my return ratio came up pretty significantly while my beta came down, which is basically exactly what I would like to see. So taking a look at the overall beta, as I was talking about, the daily return beta that I've been collecting over the course of about 2 years, this is basically what it looks like. Nothing too major to look at. Like I said, I don't really think about volatility as actual risk, but I do like to think about it in terms of like correlations of different asset classes in a macro sense. So 0.68 is where we were at the end of the quarter, roughly speaking, with an R squared of 0.55, which means that roughly speaking, that trend line explains about 55% of the actual code movements between these dots. So the idea that I'm saying the beta is 0.68%, it's really like, I can say with 55% confidence or so that the beta is 6.68. It's just kind of a statistical way of thinking. So last few things that we're going to get into is we will take a little bit closer look at my portfolio at the end of the fourth quarter and currently. Something I'll try to do with the end of these quarters pretty typically, talking about my top 5 positions. Again, as I said a few slides ago, that this is top 5 positions by the capital put into the position and not where it is in terms of market cap. But they're often the same, but they're not always the same. So with that, the fourth quarter, my top position was Fidelity National Financial, ticker FNF. It was about 15 to 16% of my portfolio, and I had 57 or so percent capital appreciation at the end of the fourth quarter. And the expected return that I had on it, in terms of contributing to that expected return of my portfolio, was 12.03%. Currently, it has also not changed. It's still Fidelity National Financial. It's been my number 1 position for actually quite some time. The portfolio weight is down to 14.5% or so. I did actually trim it a little bit, not too much, but that has to do partially because I thought there was lots of return potential still. The capital appreciation is down to 47%. In fact, I believe it's down more now because it is an industry where that's a little more sensitive, but I'm still pretty confident with it. However, the expected returns are up, both because it came down in price and because I upped the expected return after updating my valuation with the 10K. So my number 2 position at the end of the fourth quarter was Tyson Foods. It was just under 10% of my portfolio. It had 25% capital appreciation and expected return of 8 to 9%. It has actually been moved downward in my position pretty significantly during this new quarter, and Corsair Gaming has come up pretty significantly during the quarter as well, coming to my second position. So Corsair Gaming is now 6.5% of my portfolio. I am down 13 to 14% on it because it has been getting crunched with a lot of the small cap companies. I do have an expected return for the company of 13 to 14%, however. My number 3 position in the fourth quarter was Corsair Gaming. So as I said, it did grow up a little bit. You can see it was 5 to 5.5%, and I was down even more at the end of the fourth quarter. So we have improved the position both by buying into it as well as the movements of Corsair itself. And the expected return, I've upped it, or it was higher at the end of the fourth quarter, so I've actually brought that down since then, having to do with the new numbers they've released as well as new guidance. And in the current quarter, my number 3 position is at&t. It has kind of moved up and down in terms of a higher and lower position. I had trimmed to that position when I was trying to lower my exposure to it because I didn't have high expectations for a long-term holding. But then when more confidence came in terms of the short-term special distribution and spin-off that's happening with the company came into fruition, I decided to change my exposure up it a little bit. I've upped it even more since then, but at the end of the quarter it was 4.81%. Capital appreciation, I was actually down 15 to 16% on the stock, and I had an expected return of 14.5%, which includes the spin-off expectations. The 4th position in the fourth quarter was at&t. So as you can see, it came back up. It was 4.61% in the end of the fourth quarter, and capital appreciation was down 18 to 19%, and with an expected return of 12%. And in the current fourth quarter position is Biogen, which has moved up in my position slowly but surely over time. It's about 5% of my portfolio with a negative 20% return currently, with a 14% expected return moving forward.
And my number 5 position in the fourth quarter was Biogen. So as you can see, Biogen has moved a little bit, but it's actually not because I bought too much more of it, because of other companies had shifted around it at still around 5% at that point. But then its capital appreciation was only 11%. So it's also because it came down well, with the expected yearly return around 19%. So I have lowered the expected return a little bit for that company. And then my current number 5 position is Alibaba Group. I have definitely been buying into that one, and have been buying it all the way down its downward trend. Portfolio rate around 4% of my portfolio, and down 26% at the end of the fourth quarter, and expected return around 17 to 18% over the next 5 years. So taking a look at the rest of my portfolio in cost weight, which again is kind of the way I like to think of my number 1 positions at the end of the year, this is what my portfolio actually looked like. You can kind of pause and take a more closely look at the tickers that it's listing there. I'm not really going to get into all of them, but it does at least give you an idea of what my top 10 positions were, and even a little bit past that, as well as you can see the cash position, as I had talked about. That tiny little black sliver there just next to the cash position, by the way, was my Bitcoin by cost, a very tiny amount of money that I'd actually put into Bitcoin, but I did kind of want to point that out. As I had mentioned in the first quarter, I did sell out of my Bitcoin, so I kind of wanted to at least bring that up. As you can see, the change over it, which here is the market weight at the end of the year for my portfolio. And as pointing out the Bitcoin so that you can see the drastic change of it now, I did essentially 5x my money on Bitcoin, even though I barely put any money into it. So it was a pretty good investment, but we decided that we don't see quite the same level of potentiality, and we don't really have the same level of risk as we do with equity. So we did get out of that position, though we do have other non company specific alternative investments that we do have our hand in, but I digress. That's stuff that we're not really getting into on the channel too much. But you can also see the changeover from Fidelity National Financial, which was like 9% of our cost weight, but it's actually like 15 to 16% of our market weight. So huge gains on that, pretty significant gains in some other areas. So taking a look also at the cost weight for the ending first quarter, this is what we are currently at. So you can see we've definitely built up our cash position pretty significantly. Fidelity National Financial is still there. Corsair, those are all the companies we were just talking about, as well as a decent amount of new companies have been added to the portfolio, as well as other companies have shifted around pretty significantly. And also the same graph by looking at the market weight, as you can see, Fidelity National Financial still pretty significantly, even though it's come down maybe 1% or 2% in total market weight, as well as some other companies have come up pretty significantly over the period. So that's going to do it for our quarterly market update. As I said, I plan to be doing these videos once a quarter, generally within the first week after the quarter comes out, both to kind of be a little bit upfront and honest about the companies that I'm holding out of the companies that I've talked about on the channel, give you an idea of where I stand with them, and even an idea of where my returns are with them, as well as the overall returns on my portfolio in general. So with that, again, if you could give us a like and subscribe to the channel, and again, perhaps show up for one of our live streams where we go in depth into these companies from time to time. I'm sure you can find something valuable to learn and use in your own portfolio.